Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London, UK feed wheat. Paris milling wheat. The market here in August, as elsewhere, constructed a new pattern. It built a mid-August to mid-October ascending wedge pattern that is highlighted in dark blue on my daily chart. Mid-October prices dropped out of this ascending wedge pattern and pushed down through all the moving averages. In this move lower, this market showed an earlier bearish incentive compared to the other grain markets. So there were here, as elsewhere, avenues for prices to travel, and it chose the straightforward move down, with appropriate potential targets for the ascending wedge pattern. A primary target down in the 331 zone, whilst the secondary harder reach target was way down in the 296 zone. The primary target was easily achieved, but it took until mid-December to reach the secondary target, which in its way is an achievement, as none of the other, well, hardly any of the other grain markets managed to reach a secondary target. So where does that leave us now? Well, I pondered on this 7 weeks ago, and I quote, "Take a look at the whole big action since the peak in May to date as possibly a very, very large bearish halfway hesitation in the making. To clarify, it is possibly in the making and it's not made, not yet. This is a ginormous pattern, and one which will eventually may lead down to something like the 225 area. I'm not prepared to call it that, not yet. However, we may have another bearish but less aggressively bearish pattern, though not necessarily by much. It is a mid-June to date bear channel, currently 256 to 332, which is highlighted in bright green on my daily chart. I'm not saying either of these two will be the way forward, but if you favour the bearish side, then these are worth considering." End of quote. These still stand as ideas and both have merit. To these I added 2 weeks ago a further shorter term pattern, and one that initially worked pretty well. It is a mid-November to late December last year bearish Andrews pitchfork, which I've highlighted in bright green. However, on Monday this week, prices punched up and through the upper tine, currently 279, which prompted me to draw a shallower bearish shift pitchfork for the same move, and which you can see highlighted in purple on my daily chart. This had previously been breached on the downside, but had repaired itself, or so it seemed. But these last 3 weeks we have seen the market rise from the lower tine of this pattern, which is currently 272, through the middle tine, currently 283, and now testing the upper tine today, currently 295. This is a crucial moment as the upper tine is reinforced with declining short-medium moving average, currently also 295, and any proper break of this will be very significant, as there is nothing above it until the combination of 50% Fibonacci line of the September 2019 to May 22 move at 301.5 and the August low last year at about the same level. We have a further 50% Fibonacci lines at 307 and 315, but by then we will have a whole new scenario if prices make it that high. London, UK feed wheat. In mid-October last year, the market made a weekly key reversal down that broke down through the lower bull channel line of the August to October 2022 move and started what was at the time the next major piece of action, a move lower which included breaking down through all the moving averages. This left this market, as elsewhere in the other grain markets, for choice of avenues going forward. Eventually, the market chose, as I described it 10 weeks ago, and I quote, "a straightforward move down with potential targets for the break below the bull channel." In this case, a primary target on a downside was already achieved in the 269 zone, whilst the secondary harder to reach target X1 is almost achieved in the 239 zone. End of quote. The prices finally dropped down in early December and reached the secondary target in the 239 zone. I also laid out 10 weeks ago the next possible scenario, and I quote, "We now have to see if the 239 zone will hold this decline, which includes the previous all-time high at 238.75. If it doesn't, then there is a series of old congestions, some dating from 2012 between 230.10 to 223.10, and another series dating from 2013 between 215 even to 217.80. These may in turn be in the frame, but let's see what the 239 zone holds in store." End of quote. Well, once reaching 239, prices hesitated, but in early January they resumed their journey lower. It was at this point that I will bring in my last words from 9 weeks ago of what was at the time a new pattern. And I quote, "There is one potentially new factor to add into the mix. I'm even not sure if it's genuine or not as yet, but we may have an October to date small bear channel, and that's currently now 186.20 to 204.40. The one thing it has in its favor is that the short medium moving average, and that's currently 232.90, seems to be paralleling it." End of quote. 2 weeks ago I added a shallower amended bear channel, currently 202.30 to 219.60, which you can see highlighted in bright green. The original one was highlighted in purple. The reason why I put this shallower amended bear channel is it seemed a better fit because of the breach of the upper bear channel line of the original bear channel at the end of 2022. But 2 weeks ago the top side began to be attacked with a weekly key reversal up. Initially it was prices punching up through the short medium moving average, but then last week the market punched up through the shallower upper bear channel line as well as the 2012 high at 227.30, and also as well as other congestion. This was more than just a warning, as a move up was not repaired, and thus both bear channels will be relegated next week. Then this week yet more happened as the market punched up through the declining medium moving average, currently 232.90, which is where we are now. At this point I should introduce target X in the 180 zone. You see, I asked the following question back late last year, and I quote, "What if the action since mid-May to date is a huge bearish halfway hesitation? A really big one. In that case we'd be looking at potential down in the 180 area." Yes, 180. I'm not as yet advocating this as a pattern, but it might turn out to be so. It will depend on what the market, on how the market treats the congestion below between 230 and 223, and the smaller lower ones between 215 to 217.80, and also between 205 and 206.40. Watch carefully, especially the integrity of the bear channel in purple. End of quote. 2 weeks ago I decided to place a potential target X in the 180 area. This week after this commentary I will be retiring that target. This leaves us with the same question: what is next? Now. Well, the next key levels topside should be should the market stabilize over the medium moving average, is the combination of 50% Fibonacci line of September 2019 to May 22 move at 245.10 and the rising shallow neckline that currently intersects this 50% Fibonacci line from December 2021 to February 22 as a reverse head and shoulders, and that's currently at 245.35. This is the first key area on the top side, and it will only be valid as long as these two stay close to each other. The second area is the combination of the August 2022 low at 251 even, the congestion at 250.5, and a declining long moving average, currently 250.5 also. This will also be valid as long as the long moving average stays nearby. Do I think these levels are possible? Yes, especially the neckline. I suspect a new pattern is in construction. You see, I think we might just have a December 2022 to date potential possible reverse head and shoulders pattern in construction. Now, it takes some viewing of this, but if you consider the first shoulder and most of the head formed, and we might be on the way to making a second shoulder, but I grant you, it does require a bit of squinting of this market.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.